The Fed meeting for the last time this year to discuss the future of interest rates hasn't really gone according to plan for Ben Bernanke. I guess that depends on who you ask. QE2 was supposed to keep interest rates low, but they shot higher since the Fed move in early November. So what are the best bonds to buy in a rising rate environment? Joining us for anything but stocks is Jim Iuorio, director at TJM Institutional Sales, and also Dave Zervos, chief fixed income strategist at Jefferies Point20. All right, thanks for joining us. We appreciate it. Jim, let me start with you. How's this day going to end in the bond market, do you think? You just heard Rick Santelli saying it's a historic day. What do you think?
Well, I think it's a big deal. And I think when you go from 230 to 340 in the 10-year, it's not just a blip. It's indicative of a new trend. And to figure out where the next leg is, I think you've got to figure out why we're here. Is it a question of inflation? You know, copper and the CRB yesterday hit new highs again. Is it a less need for a panic instrument as kind of good news from most of the world drowns out the bad news out of Europe, at least for now? Is it a question of extra issuance that comes with less tax receipts? Or is it just a whole part of a huge sovereign debt thing? I mean, remember, that's the problem in Europe, is just sovereign debt become, not palatable for a lot of people's risk. And I think of those four things, they all figure in it, but the most important thing is inflation. I think that with the tax cuts, the market views it as good and positive stimulus for the economy that comes layered upon 2 years of kind of dollar devaluing policy. And I think right now that scares people a little bit. So my objective in the 10-year is 4% over the next year. Yeah. And the way I am long the TBT, which is the double short, the long end of the U.S. yield curve. And if we get a move higher in rates, that should do well. I've been long it a couple of weeks now.
All right, but Dave Zervos, almost all of the 75 basis point or nearly 100 basis point jump in treasuries is real. You can see that from the TIPS market. If economic growth rising is pushing treasury rates higher, how does that affect corporates? Because corporates like profits, corporates like economic growth, and maybe even high yield likes economic growth.
Well, I agree with what you just said on the high yield, and certainly we like at Jefferies a lot of the commercial real estate-backed bonds and some of the private label mortgage-backed bonds as a place to hide with higher yielding securities as we back up in government rates. But I actually completely disagree with your first statement, Larry. I don't think TIPS tell you much of anything. I think it's an asset class that is a very peculiar one and doesn't really give you any indicative nature of where either inflation expectations are or real rates are.
How can you say that? The market trades well. I mean, look.
Oh, come on, Larry. Have you ever tried to trade a TIP? It's not a very easy thing to do.
The yield on TIPS has gone up to about 90% of the increase in the yield on the 10-year. I mean, you may as well dismiss the whole Treasury market for that.
No, Larry, that's not true. The TIP market is completely different than the U.S. Treasury market, and the signs that there's actual real inflation expectations are because the curve has steepened massively during this, that our counterparties who own lots of our trading partners who own lots of treasuries overseas are complaining a lot about QE2, and the fact is people are running for the hills for risky real rates because
you think this is inflation?
I think this is actually inflation expectations, and that's what Ben Bernanke is trying to do. That's why QE2 has been successful. That's why people are jumping into real risky returns like equities and away from non-risky real returns like treasuries.
David, are we ignoring the just screaming higher commodities market? Copper, wheat. Oh, no. Everything that people need is going higher. It seems to me that the only thing that's not going higher is housing prices.
Well, that's what I was just saying. It's inflation expectations, and inflation is there as well, but it's really inflation expectations. Well, Larry was arguing it wasn't inflation expectations. He was saying that it was real, and I think that's a mistake.
And I point to the fact, by the way, that the dollar has improved over this period because of higher real yields, and also that the gold price has stalled out. See, I think the rise in industrial commodities is good for economic growth. But if the gold price has stalled out, then that tells me this is economic growth, real rate driven, gentlemen.
Hey, Larry, I'll give you a little piece of history. Back in 2008, some of the front-end TIPS were actually predicting negative 6% deflation over the next 2 years. That's how good they were at predicting inflation.
Yeah, but the negative rates on TIPS
again, I'm just trying
to
put it in perspective that these things are not very good predictors of either inflation expectations or
would you sell all bonds then? And look, inflation is the bane of bonds. If that's the case, would you sell all? Would you sell corporate bonds? Would you sell municipal bonds? Would you sell the high yield bonds?
I mean, our target has been 5% in the U.S. Treasury note for a while now. You know that, Larry. We've been on a couple times talking about it. We think there's a lot of things lined up that look pretty negative for the back end.
High yield too, though? You're going to get out of corporates as well?
No, I think we think the right corporates with the right spread is all going to compress. So we've got bonds that trade. If you have bonds that trade 200 or 300 over, you're going to be in a decent place. If you have bonds that trade 20 or 30 over, you're going to have a problem.
All right, gentlemen, thank you very much.